Hello, everyone. Today on the final bar, I'm joined by Tony Dwyer from Canaccord Genuity. Happy Fed week, Fed day, as we wait anxiously for stimulus news, but get news from the Fed. And the market's sort of choppy, rallying a little bit going into the afternoon, but overall, pretty much finishing flat. We've continuing this sort of leadership rotation theme back into the large cap growth space, away from things like energy, industrials, and others. What does this mean for the remainder of the year? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together using the power of StockCharts, using the visualization we can use to interpret, quantify, and analyze investor psychology, behavior, decision-making, all of the good stuff. You know, this week with the Fed, coming out, not huge surprise. I mean, overall, it's sort of more of the same at this point. And I think, a lot of these sorts of things are essentially priced in, and you can see how the market didn't react a ton. It rallied a bit, but gave most of that back, finishing around the 3,700 level. I think the real story here going into the end of the year continues to be this leadership rotation theme. The market can be flat to positive, but with a lot of movement, relative movement between the sectors. And what we've seen today was a rotation back or a continued rotation back into sort of the large cap tech, communication services, consumer discretionary, really more than that, with stocks like Microsoft having a decent day, pushing further to the upside. Apple earlier this week, sort of the news there. On the downside, it's some of the defensive stuff, some of the late cyclicals, and we'll look at all of that and more. As I mentioned, we have Tony Dwyer joining us momentarily from Canaccord Genuity. Excited to get Tony's take on the market environment into year end and beyond. Tomorrow, we have Dr. Alan Ellman from the Blue Collar Investor joining us for the first time. Starting next week, we'll be taking 2 weeks off of the show, so we'll be very excited to join you in the new year on January 4th. But between now and then, you have some fantastic special programming all around year end. 3 sort of segments of the year end programming for you. First off, it's 10 strategists giving you their top chart theme of the year. So 10 and 10 over the 2-week period, different strategists every day. We'll have a second series of programming all related to sector rotation. So Julius DeKempener, founder of RRG Research, is going to talk you through some key sector themes. And we have some analysts digging into particular sectors and giving you the lowdown on how to interpret their movements going into the new year. Finally, a third set of programs particularly designed around the year-end review process. How do you evaluate your performance as a trader, as an investor? How do you start to set yourself up for success in the new year? So a couple really thoughtful analysts and educators to help you think about how to debrief on this this year. I feel like we all need a pretty major debrief after the volatility and the uncertainty for 2020, but how do we set ourselves up well for the next year? So that's all called Reflections 2020. Starts this coming Monday, and we're very excited to share with you a lot of really cool content, particular to this time of the year. Let's continue on with our market recap. As I mentioned, it's been about rotation. So when you see something like the S&P flat to positive, it seems like it's sort of a story day. There wasn't much going on, but there's a lot going on if you look underneath the hood. And I think, as we've talked about, I think of it as a stock picker's market because there are movements, there are opportunities to be overweight or underweight. There are groups and themes that are working and those that are not. And I think, the way to outperform in this sort of environment is lean into what is working and lean away from what's not. Focus on the relative movement that you can identify as where things like the RRG can be quite informative. In terms of what happened today, the S&P closing just above 3,700, and that 3,700 level has been very important. We've closed around there, attempted to push above there, and really haven't had the follow through just yet. So while 3,600 was a key level we watched for a while, 3,700 now in the short term becoming that next ceiling that we would need to get above there. The NASDAQ powering higher today, up just over around 0.6%. Mid caps and small caps actually lagging behind. So, it's interesting. You see the market sort of flat to positive. You see mega cap technology driving higher just fine, and you see small cap value struggling. So this is sort of this, this bifurcation of the markets, if you will, sort of the haves versus the have-nots. And I think you're going to see some barbell types of movements here. It's not all, everything's not all moving together. The VIX back down around 2250. Non-equity markets, we have bonds down just a touch in the form of the TLT, the 10-year yield down a bit to around 92 basis points. Metals and commodities really worked pretty well today, with gold up 0.5, 0.6% in the form of the GLD. Most of that came toward the end of the day with a nice spike around 215, 230 Eastern. But I tell you, the biggest movements were in cryptocurrencies, with Bitcoin closing above 20,000 now for the first time, and really matching the level that it met years ago. You've seen this stepwise motion higher with cryptocurrencies, and with Bitcoin in particular. This is a pretty significant milestone to get above here. The question, as always, is the follow through. Let's actually start there. If we look at the chart of Bitcoin, I actually wrote an article not too long ago on See It Market talking about Bitcoin and how it measures to 37,000. And that's just using the height of the base. If you look at the basing patterns that you've seen, so, take the peak from July, take the low from March, and then returning to that level, you can use that sort of thing, use the height of those patterns to measure and project where they are. So depending on how you measure that, you get to some different measurements. So that initial take, if you take a low around 4,000, a high around 14,000, and now we're getting above 20,000, right? So you take the height of this and add it, that measures to around 24,000, the very simplistic way of just taking the height of the pattern and projecting it from the breakout. But if you look at a longer term trajectory of Bitcoin, you look back a number of years and look at the all-time high back to where we're at, that's how you measure up into the mid to upper 30,000. So, certainly demonstrating over the last 6 months that resistance is great, and then it breaks through it and it retests it, and that pattern has continued for a number of times. So, certainly there are plenty of reasons why Bitcoin could go higher or lower, but overall, I tend to think of the trend is in place until proven otherwise. Certainly seems to be pointing higher at this point. Let's look at some gold real quick here. So we'll look at the GLD. So as we've talked about, gold certainly has been choppy, and the net movement over the last 4 months has been negative. If you look at the gold spot, if you look at the GLD, you get a similar message there. What happened, though, is you broke down below the 200-day at the end of November, and it's bounced back up. And now we're really sort of in that no man's land between support and resistance, right? To really, indicate a higher movement from here, you'd need to get above the last Fibonacci resistance level, which was also resistance from October. You had sort of a blow-off rally there in November before it pushed to new lows. And if we would sell off here, you have a clear support level now just above 165. So sort of range bound between those two extremes. And the question for me is, which way are we going to break? The RSI is literally neutral, which it's been for a while now. So overall, it's essentially, if I had to pick a direction, I'd pick lower, only because that's the larger trend that I'm seeing is lower highs and lower lows. And until that breaks, I'm going to assume that trend continues. I think getting above 180, getting above these previous swing highs would certainly convince me that there's potential for further upside there. The chart of the S&P really speaks to, the persistent uptrend that we've seen. I've seen the S&P go on a rotation from, really an impulse move out of the March lows that really ended in early September. We then had this range bound move, this consolidation period. And the way I'm seeing this as time goes on is more that this whole experience from September to October is really just overshooting and undershooting the February high, right? We sort of overshot it in September. We undershot it in end of September. And then again, we're just rotating around that equilibrium point, which is right around 3,400. We've now changed that, right? That now has changed, and stocks are pushing to new highs. This was driven in some way by financials, by energy, by some of those things that gapped higher, and into November really, pushed to the upside and really changed the character of those charts from underperformers to outperformers. Now what's happening, though, and I think this week is interesting, and I wouldn't be surprised if this theme continues through year end, is it's more of a rotation, right? The market sort of flat to positive, not blowing the lights out strong, but not, in anywhere, any negativity. It's sort of just a slow and steady gainer, but there can be a lot of rotation underneath there. And I think, to transition into the end of our market recap, looking at charts like Microsoft or what show that, again, it was up a little bit today, 2.4%. But stocks like this now, mid-range, but starting to break out a little bit, and seeing if some of these other charts that have sort of been mid-range, these FANG names, Netflix now in the last couple of days trying to break above previous resistance. Is it able to regain those previous highs, push beyond there? It's also worth noting, again, in any environment, there are stocks that are working and stocks that are not. There are plenty of stocks making new 52-week highs, or at least new swing highs. Chipotle was one of the biggest gainers today, up about 4% at the close, but finally getting to a new 52-week high again today on a closing basis, as well as an intraday basis. PayPal is one of those work from home names, payment processor, but I like the break to new highs. So, so again, sort of in a consolidation phase, September, October, November, testing this resistance level here in early December, and now resolving to the upside. So certainly you could see further highs as that goes to a new price high, a new 12-month relative high today. You also have things like Peloton, which were sort of the names that rallied significantly off of the lows. This is we're all stuck at home forever type of trade, and it just worked so well from the March low to empowering to new highs, an incredible run of outperformance. That pulled back, and I don't have the Fibonacci retracements on here, but it's literally 38.2% of the retracement from March to October. We pulled back right there. Now that's rotating back higher and testing the all-time highs around 140. It's not everything though. So something like Zoom has not. It's sort of Peloton, but Peloton now is recovering and Zoom is not. So remember, it's not a homogenous, everything's the same. The market is made up a lot of individual names doing their own thing. So I'd encourage you to be focusing on the stocks that are working, stocks are able to break out, and stocks are able to follow through effectively. We need to take a quick commercial break. Back with Tony Dwyer from Canaccord Genuity. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We so appreciate you joining us every weekday after the close to look at the charts together, focus in on some of the key themes, the key movements that you need to be aware of. As a reminder, we love hearing from you, in particular questions that are coming up in your own process of analyzing charts, making trades, thinking about your portfolio. So let us know how we can help. Shoot us an email, thefinalbar@stockcharts.com, on Twitter @finalbarsctv. Or on our YouTube channel, just put a comment below the video that you're watching. We'll do another mailbag segment at the end of this week, and we'd love to answer one of your questions on the air. I want to welcome on our guest today, Tony Dwyer. Tony's at Canaccord Genuity. He also runs Dwyer Strategy. I've known Tony and followed his work for a long time, and it's always a pleasure, Tony, to hear from you and hear what you're thinking. Welcome back to the show.
It's great to be with you, Dave. Thanks for the opportunity.
So obviously, Fed Day today, Fed Week, as we think about, this last meeting for 2020. Walk us through where you're thinking about the overall market environment going into year end and into next year, starting with your first chart here.
Well, Dave, I'd like to take it away from just the price action of the S&P 500. Just as a recap, we do expect we would rather buy into whooshes like the September swoon that was 10% in the S&P, the 8% drop in that end of October move, and one of our favorite indicators is the percentage of stocks above the 10-day moving average. And when that drops down into single digits, it's a pretty good indicator that the market's getting washed out. Right now, things are a little bit too optimistic, so I think we're going to see some volatility over the next couple of months. But frankly, the macro backdrop is really extraordinary. You have this excessive liquidity, historic excess liquidity, and at the same time, a synchronized global recovery. So that's the backdrop. Now, the chart that we have here is government debt. There's three components to this chart. The blue line on top is the gross federal government debt, which is $26.9 trillion. So if you see that has been going up and to the right. Frankly, it's the same chart as the S&P 500, but it's been going up and to the right for years. Because one of the biggest concerns everybody has is, geez, there's too much debt. How are we going to get out of all this debt? And then in the middle line, what you've seen is the annual rate of change has spiked just like it did in 1980, just like it did in 2008. You get a spike when the government has to help things out. So your annual rate, so not only is debt extraordinary on an absolute basis, it's even had a spike. But here's the big bond market secret. The interest expense on that debt has collapsed. It's down about 40% just from where it was at the beginning of the year. I'm not even talking about going back since 1985. Just despite the extraordinary amount of stimulus and monetary action that has taken place in the last 2 quarters, because of the drop in interest rates, you've had a huge drop in the interest expense on that relative to government spending on that debt. People always talk about the absolute level of debt, and they forget to think about what is the interest expense on that debt, and it's historically low. So if you want to go to the next one.
Yep.
So the second chart I wanted to go over today, Dave, is this chart of real liquidity. Real liquidity, and as you can see, these charts are provided by Ned Davis to us. Real liquidity measures money supply M2, plus equity and bond mutual funds and ETFs, the growth rate there. So you look at readily available money, money that you can have today. It's already in your bank account, or it can be in your bank account if you sell one of your very liquid equity, bond, mutual funds, and ETFs. So readily available money minus what it takes to create economic activity as seen through industrial production growth. So it's the money that you have versus what you're using for economic activity. And as you can see, in the summer of this year, you hit a never before seen level at almost 30%. Incredible. Similar to what happened in the summer of 2009. So I think, Dave, that all the market things that we're looking at, so this chart is showing you that the excess liquidity is extraordinary. And the reason that's important is sustainable economic downturns and bear markets, sustainable bear markets come with a need for money and no access to it. That red line is telling you you have historic access to it. And the reason it begins to go down from peak is because it's actually that excess money is actually being put to work in economic activity. So we have a lower interest expense, not just at the government level, but the corporate and household level. And we have excess liquidity that can fuel growth as we come out of the pandemic.
You know, it's so interesting, this comparison to where we're at now or recently versus 2009. And you and I, Tony, were talking earlier about just in terms of breadth, the breadth characteristics now, what you're seeing, there are a lot of similarities to 2009, just the acceleration of, stocks above moving averages and everything coming out of the lows. I think the concern for a lot of people is that, the Fed runs out of gas, runs out of steam, doesn't have anything left. But from these 2 charts, it certainly seems like that's less the case than I think people are expecting, right?
Yeah, and that's one of those, made for TV kind of comments that the Fed's out of bullets. It's
right.
You're famous for going on TV and saying, "Oh, the Fed's out of bullets." No, they're not. We're a primary currency. We can print as much money as we want.
Right.
Now, you could say that's right or wrong, good or bad. It just is. So the idea that the Fed is out of bullets is obviously not right, or we wouldn't have had a historic level of excess liquidity.
So it's interesting you mentioned the benefits of, opportunistically waiting for, I think you mentioned the percent of stocks above their 10-week moving average, right? It's just a good short-term gauge about what pullback. And I think there's certainly a fear of missing out, the FOMO with what's happening with stocks, at or near new highs. I mean, if you had new money to think about between, now and the next couple months, is it more of a, wait for some sort of actionable pullback? Is it something that you would think of scaling in? How would you generally approach year end into the first quarter?
I would wait for an actionable pullback, especially in the areas that we've been overweight: emerging, small cap, and cyclical. I think those 3 themes, Dave, are going to be there for years. I think people are trading it like it's a quote unquote trade, which was the case in May and June. Remember late May and June?
Sure.
The BKX, the KBW Bank Stock Index was up, I think it was 20% in 2 weeks. There was incredible moves out of the same stocks that are moving now. Here's the big difference. We know what the Fed monetary policy is going to be for the next 3 years. And we know that by next June, everybody should have been vaccinated. So this is more of an overbought correction call than some kind of fundamental shift. So I would wait for an actionable pullback in some of those names that have just gotten too extended here near term.
Tony, it is always a pleasure to have you on. I wish you the best. Wish you great holidays. Stay safe. Fly safe. Keep the blue side up, and we'll talk to you again in the new year. All right.
You too, Dave, and happy holidays to everybody and my friends at StockCharts.
That's Tony Dwyer from Canaccord Genuity. He's also the founder of Dwyer Strategy. Does such a great job of taking and what I've met with Tony for years and so enjoyed learning about how he approaches things. And what I always found was he would bring things that feel very complex and certainly are. I think he simplifies to the point that you don't realize the rigor and the understanding that goes behind some of the comments that he does to make things understandable. But really appreciate that take, especially this week as we're hearing from the Fed today. Want to continue on with our next segment called Getting Sentimental. A lot of times we'll do this, regularly. You have a guest on to review some of the sentiment readings. It's just been such a fascinating time thinking of where sentiment is at in terms of extremes. I've used the word euphoric and euphoria to describe the relationship to sentiment recently, and I still think that that makes sense. What you'll see as we go through some of the charts together, we'll talk about volatility, we'll talk about some survey data and put call ratio, we'll look at the options market, but I just want you to see that, overall still at, pretty record extreme levels. They've come up a bit, in terms of lightening up from the euphoria that we saw a couple weeks ago. And I think you'll see that on some of the charts. And, the VIX overall is still at a relatively low level relative to where it's been for the last year, but it's come up a bit from, from extreme lows. So let's look at some of the charts and think about what that means. On yesterday's show, Jay was with us and had a really fascinating, Jay Soloff talked about volatility and some different ways to think about it. So I'd encourage you to check out his comments if you missed yesterday's show. But I did want to just start with the VIX and the overall measure of volatility. I usually, highlight some of the extremes to point where they're at. I left this annotation where I put it in mid-November as a cautionary tale to myself. I noticed that the VIX had gotten down to near where it was in August, which was, just before that sort of short-term top. And I thought, all right, we're at a similar level. That means the VIX is clearly at an extreme relative to where it's been. Volatility actually continued to decrease for the next 3 weeks after I put that on there. So it's a reminder that the VIX is not bound necessarily, right? Extreme highs and lows are relative, and it's all about where it is relative to where it's been, but it does not mean it can't go a little higher, a little lower. There's no exact floor ceiling like the RSI or something where you can say it's not getting above 100 no matter what. So the VIX actually did get back down. It stayed above 20, which I think is interesting, and has bounced up a little bit. Overall, still, again, the average volatility, if you look over time, relative to where we've been over the last year, is certainly at the lower point. It lines up with some of the historical peaks that we've seen. And if you look at what we saw in August, you saw the VIX down around 22, 2150. You saw the increase in the VIX as the market went higher. And then we had the September peak. Here again, if I move that over a little bit, you think visually here, sort of early December, you had a low VIX just above 20. We're now rotating higher just a little bit as stocks have gone higher a little bit. This could be sort of that September peak we're sort of getting into. I'm not sure. And again, the volatility and sentiment for me is less of a timing tool and more of an indication, more of an overall sense of where we're at relative to where we've been. So I think it's worth keeping an eye on that. And price, of course, as always, is king. AAII survey, this week's data will come out tomorrow. It'll be interesting to see as the S&P goes to another or threatens a new closing high this week, what that means for individual investors. But, we've essentially remained over the last couple of weeks around 50%, 45 to 50% bulls, which again, overall as an average rating is pretty extreme. We had a big spike here about a month ago, 6 weeks ago, when we spiked up to the highest level we had been since the 2018 peak, or just before that. This was in the first week of 2018 that you saw that. So we've had an extreme move similar to previous blow-off tops, but then we've stayed sort of elevated here. And so I guess the question is, what is that? How do investors deal with the market going to new high? Extreme high bullishness for me always gets me a little nervous as a contrarian, wondering, how sustainable that might be if the proverbial last buyer has made their trade. In terms of positioning data, there's two things we tend to look at: the name exposure index and RIDEX flows, which is in red at the bottom. The name exposure index basically shows you active investment managers, how much they're allocated to equities, and it's basically leveraged long, which is where it's been for the last 4 weeks. This weekly reading not quite updated yet, but you can see where the last 4 weeks have been. So again, when I think of concerning contrarian signals, this measure being above 100% tells me that active managers are sort of going all in on equities. And while that's good, and that's what will certainly help to push prices higher, you find a lot of times that happens not at the early stages of a bull trend, at the later stages. And again, similar to what Tony Dwyer was saying earlier, it could be just a brief pull back, a cyclical downturn before a resumption of the uptrend. That would totally make sense with historical trends in this data. But, when I'm thinking about where we're at relative to year end, you think about this FOMO, this fear of missing out, the fact that investors are sort of riding prices higher, you feel like there could and should be a deeper pullback that could end up being buyable. Ridex flows, by the way, again, remaining at literally all-time highs, really all-time low readings, which is basically all in on bullish funds. The last thing I'll just hit you with is the put-call ratio, just very briefly. We've seen them at extreme lows. This is the total put-call ratio, which includes index options. This last one is the equity-only put-call ratio, which is what I usually refer to on the show. Both of them had been at extreme lows. The equity put-call ratio, the lowest it's been for years. And both of those have come up a little bit, basically saying that extreme bullish positioning, if you think of call options as the bullish side of that ratio, extreme positioning on the call side, that's come up a little bit. Overall, again, the average is still relatively low, and that concerns me in terms of where we're at relative to where we've been at some of the extremes, some of the pullbacks that we've seen in stocks going back for the last couple of years. So that is our read on sentiment. Again, it's a little less euphoric, but I still think if there was an adjective, it's probably something like euphoric that I would use to describe it, or definitely elevated is how maybe the adjective I would rotate to, but still something to pay attention to. Most important is price, and let's do ourselves a favor and focus on price primarily. We need to go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is Bitcoin to the US dollar, $ BTC USD. We have a number of cryptos, about 20 of the most liquid cryptocurrencies on our platform. I'd encourage you to look at the market summary page, which has all the tickers listed out. But this is the way to look at Bitcoin, a pretty significant move. And what you saw with Bitcoin was a rally to around 19,000 and then sort of chopping around in this area. And as of today, the last 24 hours, you've really seen Bitcoin rotate to the upside, closing above 20,000. This is the daily chart. If you look back, let's say, 5 years or so, this will give us a little more data. You can see why I mentioned 20,000 as a significant level. This is late 2017. This is the peak you saw in Bitcoin. And if you take this as a huge base and take this peak to the low that you saw in 2018 and measure that up, that's how I got to 37,000 as an upside target on Bitcoin. There's a lot of places there's a lot of movement between here and then, but that's why it was on my radar, and an important chart to pay attention to. Chart number 2 is commodities. We've seen the strength in commodities. The GCC is an equal weighted commodities ETF. There are a couple different commodity benchmarks you can look at. DBC and the CRB index are two that we tend to refer to on the show, but this is equal weighted, so it sort of takes the energy overweight out, and it's a little more spread between ag, softs, hards, and everything, metals and so forth. And what you've seen here is the rally into consolidation September and October that resolved to the upside. Now the GCC is testing a new 52-week high, testing this level. So with something like this, you usually expect some sort of resistance, but the fact that it is round-tripped from the peak in late December last year, the low in March, and now coming back up to that level as the RSI nears an extremely overbought region, I think that's certainly a chart to pay attention to. Number 3 is utilities. I mentioned earlier in the introduction, talking about the market recap, I think you're seeing a leadership rotation. You're seeing this rotation around some of these different themes, and I think overall stocks can continue to appreciate certainly into year end. That's pretty standard, and into the beginning of next year. It's all about what happens next. And I think the utilities chart has rotated back down. You saw that breakout and the outperformance September, October, November, and now continuing in December is relative underperformance. You're seeing a bit of a distribution today, and I think it's all about that support in the 61 to 62 range and whether that is able to hold for the XLU. That's our show for today. Thank you so much for joining us. Special thank you to Tony Dwyer from Canaccord Genuity, joining us from the New York area today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.